Achieving financial success takes dedication, discipline, and most importantly, a plan. For over 30 years, Don Reynolds has helped savers define their needs, formulate their plans, and achieve their goals. From accumulation to preservation and protection, and through the income distribution phase in retirement, implementing the right strategies makes all the difference. Your retirement is our business. Welcome to Strategic Asset Preservation.
Hello, everybody, and welcome to another episode of Reynolds Wrap. Of course, I'm Don Reynolds. And
we're still here. Hello, everyone.
So, if you listened to our last episode about Social Security, we mentioned that today we're going to talk about paying off your home early. And boy, I'll tell you what, there's a lot of scuttle about that. We've even got people talking about taking reverse mortgages now. It's pretty ironic where it's all going, but we understand, that's the key is, and we're not here to tell people right or wrong. That's not our job. And I think what we're going to do with this is me and Corey are going to kind of debate it back and forth a little bit. One thing, mortgage rates now they're up there a bit, they're about 7% for a 30-year rate. And so I think, a lot of people have kind of like, that's almost shock because they can't remember way back in the 80s, early 90s when they were 12, 14.
Exactly.
So we're still actually fairly low historically when you look at it, but people got spoiled when we were getting rates at 2.5%, 3% just a few years ago. And so, we have a lot of clients come in and ask the question, should we pay off our mortgage? Well, I guess there's not a right or wrong answer to that, we don't think. I think the situation kind of dictates it. Number one, if you've got a rate at 2.5 or 3%, we feel very confident that we can earn more on your dollars than that long term. Especially right now, we can guarantee you, 5 years of 5.5% on the money. So should I take a bunch of money and pay off a mortgage where I'm losing purchasing power and growth on those same dollars? Because I look at it like this. Well, if I get 5.5 for 5 years, that's probably enough money if I've got the money to pay the mortgage off where I can make the payment with that interest.
Sure.
You know what I mean?
Yeah, I understand that. And that's one side, right?
It is.
I guess I was raised, thinking back to mom and dad, and yeah, you mentioned those high mortgage rates. I remember theirs being 16 or 17% back when I was a young kid. And I got my first mortgage, back in the 90s, I think it was 91, 92 at 7%. And they were amazed, but they still told me, even though that's a low interest rate, debt is debt. And I know my parents are raised in an era that debt is bad and to try to pay it off as early as you can. I don't care if it's a 1% interest, any interest, you're throwing that money away, if you will. It's not money that you're making, you're losing. I understand your argument on that, but there is a sense of just peace of mind and security in being raised that being debt adverse is the way I'll call it. And especially when you look at a mortgage, most of them are 30 years, unless, obviously you got many different options, but most of us take a 30-year mortgage. It's kind of broken up into thirds, if you will. That first 10 years or third, even if you have a low interest rate, most of that payment's going towards the interest rate. You're not cutting the principal down at all.
That's true.
That doesn't start happening to the last third. And that middle third, you're kind of paying a little bit of both. So early on, even if it is a low interest rate and potentially you can make more, there's no, there's some guarantees now, but again, how long will that last if inflation ever does correct itself and they reduce the rates? So, I kind of see that side of it with the clients and people we talk with in the public about, what do I do? Do I pay it off or don't I?
Right. No, and again, there's no right or wrong answer. I think it really, the situation, I'll be devil's advocate. So let's say you could get 5.5% for 5 years and your mortgage is 3%. So you're making an extra 2.5% on that money that you would use to pay off the mortgage. Well, a lot of people don't know, but what if you double up your payment?
Yeah.
Or just break it up to every bi-weekly payment?
Yeah.
Just on a 30-year loan, if you do a bi-weekly payment, that reduces your mortgage from 30 years to about 22. A lot of people aren't aware of that, but that is a fact. And it doesn't matter what your interest rate is because you're paying extra because you're doing it bi-weekly.
Correct.
So
you get an extra month.
Yeah, you're getting a whole extra month in there, and that makes a big difference. And if you're making extra interest on them, on the dollars that you would use to pay off the mortgage, maybe you could make double payments. And now you're really going to cut that mortgage in half. So again, there's arguments on both sides.
Yeah. I think that's a good point there. And part of it too would be for the listeners and, sitting down with us to look at your personal situation is, where are the dollars coming from that you're going to potentially
Right.
pay the mortgage off early or make this double payment or pay it bi-weekly. Because if it's from qualified accounts, if it's money coming from a 401k or a traditional IRA or a 403b or pre-tax dollars, and you take out money from those accounts, then that is taxable. So part of this would be potentially everyone's situation could be different because of where's the source of the money that you're getting these dollars from. And is it after-tax dollars, pre-tax dollars? What does it mean for your taxable income for that year? So, perhaps as Don's saying there, I can see some of that is that, all right, well, yeah, maybe we do just make bi-weekly payments because now we're making 26 payments in a year rather than 24. So you get 2 extra payments, which is an extra month. I know when I was on a W-2 job and I was paid bi-weekly, I loved it because there were 2 months where I got 3 paychecks a year, and that extra check was nice. But again, it's going to maybe come down to, where those sources of those dollars come from. What does it mean if I pull them out of an account, or do I have cash, or do I have, and I certainly don't want to use emergency funds, in my opinion, to pay that off because that's important to have. So,
Right.
the debate continues. And I think Don's hitting the nail on the head. I don't know that there's a sincere right or wrong. I think it's each individual circumstance and letting us look at that for you and give us, giving you our professional advice as to where the dollars would come from and what would it mean in your situation. Using our software program, we can show you the cause and effect of paying it off early to not paying it off.
Right. Well, and just to elaborate on what Corey was just talking about too, if you're using qualified money, IRA dollars, and let's say you got $150,000 mortgage left, and you've got $1 million IRA. Okay, well, yeah, we want to try to spend that down, but in order to get $150,000, you'll probably have to take $250,000 of that, potentially, maybe not quite that high, 225, because you're going to give $75,000 to the IRS in taxes. So now you're looking at, and I relate this to doing conversions with IRA money. The rule says if you convert IRA dollars, you do not pay the tax out of the dollars you convert. You have to have other dollars. Well, I think the same rule would apply here. If you're going to use IRA money, fine, but you cannot take an extra 75 grand out just to pay the taxes. You're losing purchasing power and value on those dollars long term. So again, there's a lot of things to be considered.
A lot of factors. And again, I'll go back to, I understand a lot of our listeners were raised as I was, that, be debt adverse and just there's peace of mind to not have debt, not to owe anybody anything, not to be paying interest on your money, but getting interest on your money. So again, I understand there's an emotional side of this. Outside of the numbers, that we can't always look at things just numbers, but that is a part and a factor that we should look at, and then blend that together with your personal beliefs, your peace of mind. And if you are of the fan, like I am, is that, you don't want to carry debt if you can help it in any way, shape, or form, then we need to look at what is the best way to do that, to pay off that debt. Is it a lump sum? Is it over a 5-year period, or just making that extra payment over, cutting it down to 22 years on a 30-year by doing it, bi-weekly? What's the best route? Or if you're the fan that Don is saying, where it's like, well, if you got a low enough interest rate and you can make more money on that, then that's that term, use other people's money. Then we can put a plan together there. And again, I think the key is letting us show you the cause and effect, and then hearing what your heart tells you, showing you the pros and cons, showing you the numbers, and then you come to a conclusion that's best for you in your situation.
Right. No, you nailed it right on the head there, Corey. Like we said, everybody's puzzle is different.
Yeah.
And, I guess that's really what we specialize is with our software programs. We can really, dive into it and show you, like Corey said, cause and effect by paying it off early. With the current tax laws the way they are, you get your standard deductions. Most people don't have enough interest on a mortgage that they're paying.
That's true.
To even get you a chance to itemize anymore. I mean, that's part of the reason they set up that, to simplify the taxes. So, having a big mortgage and paying a bunch of interest may not benefit you anyway. So again, there's the pro to paying it off, but then you got to look at, okay, what's the con? Well, where's the money coming from? Is there value in losing growth on my assets when I've got a low interest rate? Now, if you've got a 5, 6, 7% mortgage, we'll have a different opinion than we probably think we got to figure out how you can pay that thing off as soon as possible. So again, there's no rhyme or reason to it. It's a puzzle, and we're here to help you figure that puzzle out. So, with that, please give us a call at 651-773-3859. Again, that's 651-773-3859. And again, no cost, no obligation with us. We're happy to sit down and look at your puzzle and see what we can do to help figure out a better plan. And maybe we can't. We don't know that, but we sure like the challenge. I guess I'll put it that way. And we love what we do, and we're here to help and educate folks. So with that, thanks for your time. We'll look forward to seeing you next time.
Yeah, thanks, folks. Have a great day.
Listen to more with Don Reynolds and Corey Stilp on the Strategic Asset Preservation Podcast by visiting 800preserve.com.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.